Hi everybody. In this series of videos, we'll review accounting for merchandising businesses. This video will focus on the purchase of merchandise inventory using the perpetual inventory method. Please do two things before you work the exercises included in these videos. First, thoroughly read Chapter 4 in your textbook. You will need the detailed information in the chapter because these videos will only emphasize the chapter highlights. Second, please download the Excel workbook included in the Canvas page directly above the videos so you can work along with the videos and practice accounting for merchandising transactions. You will get the most benefit from these exercises if you will take the time to pause the video to prepare calculations and write journal entries. Then start the video again to check your answers. If you got it right, you'll feel great. If you didn't get it right, there will be a detailed analysis of the correct answer that should give you an opportunity to understand and fix your errors. There are two general methods for accounting for inventory. The periodic method is usually easier and a little bit less expensive to apply, but the huge downside is that the books are only periodically correct after the company makes a physical count of the inventory and then adjusts inventory on the balance sheet. The perpetual method, on the other hand, is usually a little bit more expensive to apply. The company has to have specialized hardware and software. They must be able to read barcodes imprinted on products. They usually have to hire more highly trained inventory personnel. But the advantages are tremendous. Theoretically, if there was no such thing as theft of inventory, breakage of inventory, obsolescence of inventory, or errors in accounting for inventory, if none of those things existed, then theoretically the books would always be correct with respect to the balance sheet asset, merchandise inventory, and the expense on the income statement called cost of goods sold. These things do exist, so usually inventory is counted at the end of an accounting period, and it usually requires a relatively small adjustment to account for inventory shrinkage due to theft, breakage, obsolescence, etc. In this class, we are going to emphasize the accounting using the perpetual method. Merchandising businesses both buy and sell inventory. Inventory is reported as a current asset on the balance sheet. Most merchandisers use the multiple-step income statement shown in your textbook in Exhibit 4.13. This is Exhibit 4.13, multiple-step income statement shown in your textbook. Sales discounts and sales returns and allowances are contra revenue accounts. We'll talk about that in a future video, but for now, know that it's a contra revenue account with a normal debit balance. Therefore, sales, which is a normal revenue account with a normal credit balance, and sales returns and allowances must be netted together. So sales minus sales returns and allowances and sales discounts equals net sales. Very important for you to understand that. Cost of goods sold is the actual cost of the items that were sold during this accounting period. In Chapter 4, you will always be spoon-fed and given the cost of goods sold number for all sales. In Chapter 5, you will have to calculate cost of goods sold, but in Chapter 4, you will always be given the amount of the cost of goods sold for each sale that you record. Gross profit is a calculated number. It is net sales minus cost of goods sold equals gross profit. And hopefully this gross profit number is big enough to cover all operating expenses and still have net income left over. You should study this multiple step income statement. Perhaps put a flag on it for future reference. So with that introduction out of the way, let's go ahead and do the journal entries to record transactions related to merchandise purchases. Under the perpetual inventory method, there is one journal entry required to record the purchase of merchandise inventory, and that journal entry is always a debit to merchandise inventory and a credit to either cash or accounts payable. Here's an example. We purchased 500 blue t-shirts at a cost of $10 each on account. Credit terms were $210 net 30 FOB shipping point. We'll talk about credit terms and freight terms in a little while. Let's do some calculations. How much did we have to pay for those 500 blue t-shirts at a cost of $10 each? Calculate the amount of the inventory that we purchased, and then prepare the journal entry to record the purchase of this inventory on account. Start your video again to check your work. We purchased 500 shirts at a cost of $10 each equals $5,000. Debit an asset account called merchandise inventory $5,000 and credit accounts payable $5,000 because it says we purchased it on account. We didn't pay cash for it. We're going to pay cash for it later. So let's talk about a purchase allowance. In a purchase allowance, we keep the inventory, but we get a reduction in cost. We discovered that 50 of the shirts were red instead of the blue shirts that we ordered. The vendor agreed to reduce the price of each red shirt by $3. We already have all of the shirts recorded at $10 each, so now we have to record a reduction of $3 times 50 shirts in the inventory that we own and in the accounts payable that we owe. Please do that calculation, write the journal entry, and then start the video again to check your work. 50 red shirts at a reduced price of $3 each equals a $150 reduction in the cost of our inventory and in the amount we have to pay to our vendor. Therefore, we debit accounts payable $150 and credit merchandise inventory $150. A purchase return is we actually don't want the inventory. We actually return it to the vendor that we purchased the inventory from. We discovered that 20 shirts were the wrong size, and we simply can't sell them. We don't want a reduction in price. We just can't sell those shirts, so we want to return them to the vendor. Please do the calculation and write the journal entry. 20 wrong-sized shirts at $10 each, because that's the price we paid for them, equals $200. We're going to debit accounts payable, $200, and credit merchandise inventory, $200. Let's talk about purchase discounts. A purchase discount is a reduction in the amount required to settle the invoice if the bill is paid within a certain discount period. These are referred to as credit terms, and credit terms are set by the seller in order to usually encourage quick payment of invoices. In our example, our credit terms were 210 net 30. And what that means is that the purchaser can take a 2% discount if the bill is paid within 10 days. Otherwise, the full amount has to be paid within 30 days. So let's talk about our example. Let's say that we paid the bill within the discount period. Let's work through the calculation together, and then I'll ask you to write the journal entry. Well, the first thing we have to figure out is, at this point, how much do we actually owe on this purchase? Well, the original purchase price was $5,000, less the allowance on the red shirts of $150, and also subtract the return of the wrong size shirts, $200, means that we owe the vendor at this point, before the discount, $4,650. The vendor is not going to allow us to take a 2% discount on amounts that we didn't actually buy from them. So we don't get a 2% discount on the $5,000. We get the discount on the amount we owe to the vendor. So let's do that calculation. $4,650 times 2% equals a $93 discount. And $4,650 times 98% equals the cash that has to be paid of $4,557. So those credit terms of 210 net 30, if we paid it within the discount period, say, hey, you can settle this entire liability by paying only $4,557 in cash, because the vendor is going to give us a $93 discount. So this journal entry is going to require 3 lines. Please go ahead and write the journal entry, then start the video again to check your work. Did you debit accounts payable $4,650 to remove the entire liability from the books? And did you credit cash $4,557 and credit merchandise inventory for $93? Because this discount reduced the price of our merchandise inventory. Now let's talk about freight terms. If you remember, our freight terms were FOB shipping point. Freight times specify 2 very important things. When the freight moves from the seller to the buyer, when that freight is physically moving across the face of the globe, the point that is specified as the FOB point is the point at which inventory ownership of the inventory passes from the seller to the buyer, and risk of loss passes from the seller to the buyer. FOB does mean free on board, and it is a geographical point on the globe. So you'll see freight terms on an invoice that says FOB Port of Honolulu or FOB Port of Oakland. In this book, it's more generic with freight terms. This book says FOB shipping point and FOB destination. When this book says FOB shipping point, they mean the shipping point is the seller's place of business. So under FOB shipping point, the ownership of the goods and risk of loss transfers from the seller to the buyer at the seller's place of business. When the book says FOB destination, they're talking about the buyer's place of business. So ownership does not transfer, nor does risk of loss transfer until the inventory reaches the buyer's place of business. In our example, we've been working, FOB shipping point means the purchaser takes the title to the goods the moment they leave the seller's place of business. Therefore, the purchaser, which is the same thing as the buyer, must make arrangements to have the goods transported to their place of business, and they must pay the freight bill. When a buyer pays for the freight to have the goods shipped into their place of business, that's referred to as freight in. And freight in always increases the cost of the merchandise inventory. In our example, let's say that the buyer paid $70 freight bill for the shipping of the original order of 500 blue t-shirts. Go ahead and write that journal entry, then start the video again to check your work. Debit merchandise inventory, because freight in always increases the cost of the merchandise inventory. And credit cash, $70. Well, that's all for this video. In our next video, we'll talk about the seller's transactions in accounting for merchandise inventory.